Yo, what's up, everybody? Welcome to What the FICC. Spencer Israel here with Ian Cully, head of FICC, fixed income, commodities, and currencies at All Star Charts. Mr. Cully, I missed you on Friday, man. How we doing?
I know. It's nice to have you back, man. Did you have a good weekend?
I did. I was in the Great White North, Minnesota, but I missed doing the show with you. What was I wasn't able to watch it. I was on a plane. What did you talk about?
I had Jason back on the show, and
Okay.
we just, we ran through some trade ideas, what he's seeing out there, some of the strength across the commodity space, what we're seeing in the grain markets. I definitely want to get more to that, speak more to those markets later in the week. But yeah, it was good. It's always great having Jason on the show. We got to bring more guests on. We got to bring him back.
Definitely we
Have all the three of us on one time.
got to get some more variety on this show, some more guests. Okay, let's go to the market recap here. Let's take a look at what's going on across the world of fixed income currencies and commodities. We'll start with gold as we always do. I guess the futures, right, is what we usually start with. So
That's right. So
what are you seeing out there in gold futures land?
Gold futures undercutting the former 2011 highs that marked the prior commodity super cycle around 1923. So earlier today, the August contract fell as low as 119.11 for. It is now rallying back up towards that 1923. So we'll see how it closes today. But if gold's back below that August contract is back below those former 2011 highs, it is messy. And that's really my line in the sand in terms of the structural and tactical uptrend. And the more I look at this chart, Spencer, starting to see a potential larger basing formation. Maybe we got a head and shoulders, an inverted head and shoulders here on our hands. And we gold trades back below those 2011 highs and carves out the right shoulder. I don't know. We'll see. Regardless, gold below 1923, and it is messy. One thing I shared with readers earlier this week on the gold rush, I find it interesting that those prior trading periods above those former 2011 highs were very similar in terms of duration. 2020, that's summer 2020, 39 days, 39 consecutive days trading above at 1923 level. Last year, 38 consecutive days trading above that 1923 level. And we're working on day 70, actually. This should be 69. Yesterday marked 69 consecutive days. So when I look at this chart, I just see, buyers, gold bugs are more persistent. I ultimately think that this decade-long range base resolves higher, but again, below 1923, it's messy for longer.
This GDX chart, Ian, does not look like the futures, at least the right side.
That's right. This actually looks a lot far more similar to silver futures. And GDX printing fresh lows is not the type of signal that we want to see. It's not supportive of risk-seeking behavior, risk appetite. So to see these fresh lows, definitely we're definitely in a period we're approaching the precious metal space with caution. Right? We want to protect capital and be sure to wait for our pitch, which we're not really getting any right now. Looking at the lower pane here, momentum, that 14-day RSI, potential bullish divergence here. We'll see what happens, but maybe we're going to get in a significant low here and we start to trend higher. But again, I want to see GDX back above 30 stat sooner than later. So moving on to crude. Crude's also a range-bound mess. This 74 level here that's it's in the middle of this multi-month range, year-to-date range. That's right around the former 2018 highs, which marked the prior cycle, the peak of the prior cycle for crude oil, between 74 and 76. Now, to the lower bound here, the 65 level, that marks a shelf of former highs going back to 2019 and 2020. So that's kind of the upper bound and lower bound of its near-term range going back to May. You know, if and when crude gets back above 74, I like to long up towards 83. You know, back towards this shelf of former highs going back to last fall. But we'll see. Right now it's messy. I think as long as it's above 65, you know, the ball's in the Bulls' court. But they got to get momentum going. It's improving, but it's still in a bearish regime. I want to see momentum back above 70. That's the kind of thing that's a kind of a momentum profile that we see in uptrends and strong advances. And the fact that we're not seeing that right now makes sense. I mean, look at the chart. It's sideways a mess.
USO chart looks the same too, at least to me.
Yeah,
to
USO chart looks the same. This is a little zoomed out here. You know, that 58 level, it's the same, you know, it's the level that coincides with this 65 level, excuse me, in crude oil. You see the pivot high from last fall, last October. You know, it also coincides with those 2019 highs. You know, 72, 58, those are the upper and lower bounds of the range. You know, if and when USO gets back above 72, I like it long up towards that 92 level, towards the summer high, summer peak of last year.
I love this next chart. This might be my favorite chart here. Just looking at the subgroup performance since the dollar peaked last fall. I hope we keep doing this chart because it is one of my favorites.
Yeah, man, I'll absolutely keep bringing it. It's one of my favorites too. You know, and you know, the dollar peaking is a significant event for risk assets across the board, stocks and commodities. And I like using that date as an anchor. And it also, I mean, we're coming up on 1 year, so we got a little ways to go, but it's just a good time period to measure the performance of all the individual subgroups across the commodity space. And what's interesting is earlier this year, January, February, you really start to see the performances start to diverge. And those base metals, grains, energy all start to catch lower, while livestock, softs, precious metals really picked up, right? Those are some of the more defensive areas. But what's interesting is we're starting to see, I don't know if you imagine looking at this almost like Jaws, like an alligator, or, you know, my kids love, you know, monsters and scary stuff, monsters, Jaws. Look, it's starting to close, right? It's starting to close. And I think, you know, seeing some of that strength in base metals, seeing grains start to rally off of the near-term lows, and also seeing precious metals catch lower. Softs are starting to catch lower. Sugar's really breaking down. You know, livestock is resilient as ever. Yeah, I think maybe we're entering a period of rotation where we could see some strength out of energy. That's definitely have my eyes on the energy space right now.
All right. As we shift back to metals here for a second.
Copper, you know, a lot of strength in the past couple weeks, you know, reclaiming a key polarity zone. Will it hold? And that's the big question. And around 375, 378, that's a level for copper futures. You know, as long as it's above that level, you know, I like it long back up towards, you know, its year-to-date highs around 4.25. But, you know, stock market bulls, commodity bulls, want to see that 378 level hold. You know, but as we zoom out, again, it's a mess, right? There's still a lot of sideways congestion. You know, also note lower pane of the chart, that 14-day RSI, copper never hit an overbought reading. Again, remember that overbought reading above 70 is the type of action, a characteristic of an uptrend. You know, it signifies the bulls are in control and they're driving prices higher with authority. We didn't get that. So, you know, that, you know, it looks very, very, let's just check and see what it's doing today. You know, copper's breaking down. Copper's breaking down right now. 374 on the September contract. And what's also interesting, we're seeing some weakness in platinum and palladium as well. Those are two areas of the precious metal space that, you know, we want to see some strength to not only support precious metals, but they also have industrial uses to support industrial base metals as well. And we're seeing weakness there as well. So keep an eye on copper. It's looking weak right now. However,
Freeport.
FCX, this is a feather in the hat for the bulls here. Freeport-McMoRan failed breakdown last month and has been ripping higher since. As long as it's above 33, 33 and a half, likely along towards 45, up towards year-to-date highs. And it's, bigger picture though, it's a bullish development for risk assets, specifically stocks. And we're starting to see that rotation into small caps and in industrials. And if that is going to continue, if that healthy rotation out of tech and into these more cyclical areas of the market is going to persist, I imagine FCX is running it back to 45. So keeping an eye on that. Again, lower pain. FCX is yet to print an overbought reading above 70 on the 14-day RSI. Again, that's something I want to see here in the coming days, definitely within the coming week. So keeping an eye on that 70 level here and the 14-day RSI for FCX.
All right, moving on to fixed income here.
Speaking of range-bound messes, I feel like I'm getting to the point, Spencer, when I'm getting tired of writing messy. I use the word messy in almost every post, every day of the week. So I got to figure out some other words to use. So if anybody's watching and you want to drop it in the chat, some other terms you would like to read other than messy. But hey, 10-year yield, it's messy. It's correcting. It's been correcting all year. When we zoom out on the chart, though, it found support. And yes, I'm talking about support and resistance on a yield chart. This 2018 highs, right around 3.25. Now, if we get another leg lower in the 10-year yield, I think it's very likely that it finds support around 3%. But right now, it's a range-bound mess, and maybe range-bound mess is the best scenario for stocks. We've highlighted that scenario over and over again. Stocks simply do not want to experience lots of volatility in the bond market. And so far, it has benefited the stock market as the SP continues to catch higher.
Jonathan in the chat said it may be ambiguous, Ian.
Ambiguous. Okay. I'll try it out. I'll try it out today.
All right.
Thanks, Jonathan. Treasury bond ETF TLT. I mean, this tells a story. I like the chart. I think it looks good. I just don't want to own it until it's above 110. If and when it's above 110, like along towards 120, it's really that simple. Until then, again, there's other places to put our money to work besides bonds. Lower pain, I added the 14-day average directional movement index. This measures trend. And when the 14-day ADX is above 20, we're in a strong trending market. Now, on the flip side, below 15, and definitely down below the teens, like when you get around 10, 11, 12, that just indicates you're in a sideways, trendless, ambiguous range. And that's where we are right now for bonds. It's really that simple. US dollar, same thing for the dollar. Dollar, bonds, rates, they're all, same story. DXY has been challenging that 102 level for the past week or so, but it's resilient. It continues to hold above this key retracement level and that shelf of former highs from 2016 and 2020. Here's a zoomed in look. That 101 level is what we're watching. I think break below there, downside risk towards 89. But again, let's flip it here on the lower pain, 14-day RSI. Never saw an oversold reading below 30. Now, a reading or a print below 30 is what we expect, or a key characteristic of a significant, strong downtrend. Bulls are driving prices lower with authority. We really haven't seen that. Right? That is lacking. So if and when we're below 101, I want to see a print down here below 30 on the 14-day RSI.
Yeah.
UUP range 2850 on the upper end, 27.25 on the lower end, and it's sideways. Hanging high taking a little higher compared to the dollar index. I like to keep my eye on the dollar index, but always have UUP in the deck here.
All right, Ian, let's talk some Forex here.
Mhm.
You wrote a blog post yesterday asking the question, what does a weaker yuan mean for US stocks? I also made that the title of today's show, coincidence or not. You be the judge. So let's talk about the yuan and the effect that it's having on other global currencies and also just the US stock market.
Right. So the issue with the yuan is that the People's Bank of China comes in every morning and sets the rate. So the yuan cannot deviate beyond about 2% above or below that rate, whatever they decide each morning. So when you see strong moves in the yuan, here we're looking at the US dollar Chinese renminbi. This is the offshore Chinese yuan that is actually openly traded in the market. Breaking above this key level here around 719 that marked the highs from 2019 and 2020. Had a bit of a failed breakout here last year. And remember, last year was around October, coincided with the bottom in US stocks, and stocks just absolutely loved it when the renminbi was rolling, or the dollar was rolling over relative to the renminbi. So it's really interesting to see this, to see the action that they're taking, from a trading perspective. I don't necessarily trade this cross, but for those of you out there that do, I mean, as long as it's above 719, the path of least resistance is higher towards 775, longer term. And I think you can be long above this level. Below this level, it's messy. Maybe we get a sweep reversal. And that's really what I want to draw the attention to, Spencer, is that, are we going to get a steep reversal? The next chart here in the yuan, and is that going to help propel US stocks higher, just global equities in general higher? So the reason that the People's Bank of China would step in and devalue their currency, which is what we're seeing here as it's falling over, is to dampen or lessen the effects of an economic downturn. So a weaker yuan, for me, I read that as the Chinese government projecting a tough economic situation for China in the coming months and quarters. So if the world's second largest economy is struggling,
Which we know
it
it is.
usually doesn't bode well for
we got more data this morning, so we know it is.
What's that?
We got more data this morning, so we know that their economy is struggling.
Yeah. So, I mean, and this is a great point. It's like you can sit around, we can wait for the data to come in, or we can simply look at the actions of the People's Bank of China via the yuan, right? We can just look at the charts and see what they're doing. And they're telling us, hey, guess what? The data that's going to come in, it's going to be negative. And that's what we got. So this overlay chart shows that, whenever the yuan is falling over and, and they're devaluing their currency, stocks tend to roll over as well. Whenever the currency is catching higher, stocks tend to do well. So what's interesting here is that we got a breakout, above those August pivot highs in the S&P 500, while the yuan is being devalued. So the question is, are we going to get a quick reversal here? Was that it? Stocks continue to rip higher, or if the yuan takes out its October pivot lows from last year, I think that's a warning sign that we could see a failed breakout here in the S&P 500.
It does look like to me, this chart, that correlations kind of come and go.
Absolutely.
Right?
Absolutely. 100%. We see that correlation kind of came and went in 2019, and the yuan had it right. Right? We see that lower high coming into early 2020, and then stocks fell off. Right? Yuan, steep sell off here.
So you're watching
Spring of
this.
2022 got the same in U.S. equities.
You're watching the chart of the yuan dollar as sort of a potential indicator for what can happen with the U.S. equities.
Yes. Yeah, I mean that's a good way to put it. And here's the thing: I'm bullish equities. To be clear, I'm bullish U.S. stocks. I'm noticing a healthy rotation. These industrial subsectors are looking great. The stock indexes are S&P 500 is holding its breakout. Like I have no reason to be bearish U.S. stocks right now, but I like to look for evidence that's going to debunk that theory, to debunk that thesis. And when I look at this chart and I look at what the People's Bank of China are doing with their currency, it makes me question that bullish thesis. And it gives me a level that I can pinpoint and keep an eye on, which is the October pivot lows, for which, if you're looking on your dashboard, you're probably looking at the renminbi. It's up here around, I think, 738. So if renminbi is back above 738, yeah, I think that's problematic for U.S. equities and global equities for that matter. But we'll see. Like this isn't it's not decisive in any way. It's more of like who's got it right here, U.S. stocks or the yuan. So we'll see. It could be either. It could be either or. But we've got a level to keep our eyes on that could definitely I think believe bring valuable insight into potential direction for the S&P 500 and U.S. stocks more broadly, in the coming months and quarters.
You ever look at the yuan versus like Chinese equities, or is that relationship rather obvious?
I think it's pretty obvious, and Chinese equities have been struggling. So that's a really
Yeah.
good point. Chinese equities have been struggling, and when they struggle, cyclical assets tend to struggle as well.
Yeah.
That's a really good point. I also brought some other charts.
Yeah. What else do we have here?
Got a few other charts. I just wanted to bring some charts to update, some of the trades that we were looking at earlier in the past couple of weeks. Talking about the Canadian dollar recently, it's running into resistance at this multi-year down trend line. It's struggling to hold above our risk level here. It's right there today. If it's not above 75.50, I step back, cut losses short and wait for this trade to continue to develop. Japanese yen, on the other hand, the US dollar yen above that 142.50 level and cruising. I think it's up. It's only up 14 pips so far today, but up to around 144.25, 144.25. So the dollar yen continuing to rip. Global equities in general are really taking the yen down. Euro yen, pound yen have broken out of these multi-year bases, these massive bases. So the yen's definitely on the ropes. And then CEW, talk a lot about emerging market currencies recently and the strength that we've been seeing out of those currencies, and what that means for dollar weakness. It's this, broadening dollar weakness. Is dollar going to take out that 101 level? It's definitely a data point that suggests that it would, and it was. But now we got a failed breakdown here, or excuse me, failed breakout in CEW. And another interesting, the Canadian dollar is also struggling. So these were two key pieces of information that were supporting a potential significant dollar weakness ahead. And, it looks messy. It continues to look messy and ambiguous.
So what's the takeaway from all this? Is that everything in your world is messy? Most things.
There's still a lot of work to be done. There's still a lot of indecision out there. I mean, is the Fed going to hike next month? I mean, we paused
probably
in June. I mean, I think, it's overwhelming consensus, at least from Fed funds futures, that we will get a 25 basis point hike next month. Yep. The rest of the world, Europe, is continuing to hike. I believe a Great Britain just hiked 50 basis points. So we're entering a period where the rest of the world is continuing to hike and maybe hiking at a faster rate than the U.S. And that's a big departure from what we experienced over the past year. The past years, the U.S. it has been just raising rates at an incredible rate compared to the rest of the world. And even emerging markets, I think the Turkey they raised their interest rate. So they were cutting there for a while, and then they just recently raised it 650 basis points last week.
Well,
which
Ian,
is wild to think, and even that hike was below expectations. So to see emerging markets pause, cut, and now start to hike again, that definitely, I think that speaks to the stickiness of inflation, and there's just so much indecision out there right now, and that's what we're seeing in these sideways, messy, ambiguous ranges.
Ian, you would have loved the currency market a couple hundred years ago, I think.
I would.
Yeah. I wanted to talk about this on Friday, but alas, I was not here to do the show. But do you know what last Thursday was? Well, I know you know now because I told you. But I'm more asking this rhetorically. Last Thursday was the 248th anniversary of the first fiat currency issued in the United States. It was called the U.S. Continental. So Ian, check this out. All right. So in 1775, the Continental Congress in the U.S. issued $2 million of this paper money. They called Continentals. So by the end of the next year, by the end of 76, $25 million worth of this currency was in circulation. Wow. Already, the value of the currency had already fallen 30%. By the end of the next year, so it's now been 2 years since the first issued these, $38 million was in circulation, down 70% from the initial value. And by the end of the 1779, so by 4 years after the first issuance of this currency, they had gone from $2 million worth of Continentals to $192 million worth of Continentals, and the value eventually fell to 1/40th of its initial value. I don't know the math on that percentage wise, but I know it's not good.
No.
So yeah, fun little history lesson that I saw last week that I think you would have loved tracking this market because it was directionally sound.
Yeah,
the trend is your friend.
Print more money. Is that the lesson?
No. The lesson is not print more money. Well, you know what though? You can't say that because they had to do it to. You gotta do what you gotta do to win a war. Okay.
Hey,
you know what I mean. You gotta do what you gotta do. So they did what they did. They won the war. Yeah. Maybe from a currency value standpoint, it wasn't the best move, but hey, they had to do it. And I thought that was a fun little lesson.
This is great. Hey, they got the job done.
Nice one, Sam. I love it. Sam is great, man. Yeah, Peter Schiff called it in 1775. That's right. He was all over this one. He's been pounding the table for 200 years. Anyway, all right. I think that'll be a good place to wrap up the show today. We'll be back on Friday, potentially with a guest. Stay tuned for that. Wanted to mention always that Ian Cully is, as part of the research team at All-Star Charts, he is part of the team that is searching far and wide for that one perfect chart to send to your inbox every single weekday. That's the All-Star Charts Chart of the Day email. It is totally free. To get that email, use the link up on the screen. There should also be a link in the YouTube chat, as well as the link to Ian's blog. You can always call us with any questions, email us. The info should all be on the screen right now. And I think that's a good wrap. Any final thoughts?
I really
Yeah,
just, the usual, get outside,
get
enjoy the
outside.
sunshine.
That's it. Always get outside. Well, actually, maybe don't get outside if you're in the Midwest this
Oh
week.
yeah, it's hot.
Stay inside if you're in Chicago, but everyone else get outside. That'll be it for us here. Have a great rest of your day. 1 o'clock Eastern time, an hour from now, the Hot Corner with Steve Straza. Stay tuned for that.
So
Everyone
hot.
have a good one.